In 1999, a math nerd in Boston sat down with a calculator and proved that the most respected investor on Wall Street was running the biggest fraud in human history. He sent the evidence to the government. They ignored him. So he sent it again, and again, 5 times over 9 years. And in that time, Bernie Madoff stole $65 billion from 37,000 people. This is the story of the greatest lie ever sold, and everyone who almost stopped it. To understand how one man fooled the world, you need to understand who the world thought he was. Bernie Madoff wasn't some shady back-alley operator. He was Wall Street royalty. He started his firm in 1960 with $5,000 he saved as a lifeguard. By the 1980s, his company was handling a huge share of all the trading on the New York Stock Exchange. He even became chairman of the NASDAQ, the second biggest stock market in America. That reputation was the weapon. Because when the chairman of NASDAQ offers to invest your money personally, you don't ask questions. You feel lucky he said yes. And that's exactly how Madoff wanted it. His investment fund wasn't advertised. You had to be invited. Country clubs, charities, word of mouth. The harder it was to get in, the more people begged to give him their money. So what was Madoff actually doing with the money? Here's the part that's almost unbelievable. Nothing. He wasn't investing it at all. Madoff was running what's called a Ponzi scheme. Let me define that in plain English, because this is the engine of the whole story. A Ponzi scheme works like this. You give me $100 to invest. I don't invest it. I put it in my pocket. Then a new investor gives me $100, and I use part of their money to pay you fake profits. You think you're earning returns. You tell your friends. They invest. And I use their money to pay the people before them. As long as new money keeps flowing in, nobody notices the money isn't growing. It's just moving. Madoff ran this exact machine, but on a scale no one had ever attempted. His clients received beautiful monthly statements showing steady returns of 10 to 12% every single year. Bull market, bear market, didn't matter. The statements were printed on an old computer on the 17th floor of his office, a floor almost nobody was allowed to enter. Every trade on those statements was fictional, every number invented. The real balance in his accounts? A fraction of the $65 billion his clients believed they had. And here's the twist. The thing that should have destroyed him decades earlier. Madoff's results weren't suspicious because they were too good. They were suspicious because they were too smooth. Real markets go up and down. Even the greatest investors alive have losing years. But Madoff? He reported gains in 96% of all months for decades. That's not investing. That's statistically impossible. Like a basketball player hitting every shot for 20 years and nobody checking the tape. The clues were everywhere. His firm was audited by a tiny accounting shop in a strip mall. 3 employees, one of them a secretary. A fund supposedly worth billions, checked by an office next to a pizza place. Nobody looked. Well, almost nobody. In 1999, a financial analyst in Boston named Harry Markopoulos was handed Madoff's return numbers by his boss with one instruction: copy this strategy. Markopoulos ran the math, and within 5 minutes he knew. The returns were impossible. The strategy Madoff claimed to use couldn't produce those numbers. The entire options market wasn't big enough to support the trades Madoff claimed he was making. It was like someone claiming they drove from New York to Los Angeles in 4 hours. You don't need to see the car. The math alone tells you it's a lie. So Markopoulos did what you're supposed to do. In May 2000, he handed the SEC, the government agency that polices Wall Street, a detailed report proving Madoff was a fraud. Nothing happened. He submitted again in 2001. Nothing. Again in 2005. This time a 21-page report literally titled, "The World's Largest Hedge Fund is a Fraud," listing 29 red flags. The SEC opened an investigation, interviewed Madoff, and closed the case. Again in 2007, again in 2008. 5 submissions, 9 years, nothing. On December 10, 2008, Madoff called his 2 sons, who worked at the firm but ran the legitimate trading side, into his apartment. And he confessed. The entire investment business, he told them, was, quote, "one big lie." His sons faced an impossible choice, their father or the law. That same night, they called the FBI. The next morning, December 11, 2008, agents arrested Bernie Madoff in his bathrobe. The fraud had lasted at least 40 years. $65 billion in paper wealth, gone. 37,000 victims across 136 countries. Retirees lost everything. Charities shut down overnight. Several victims, and Madoff's own son, Mark, later took their own lives in the aftermath. Why? Because Madoff was the chairman of NASDAQ. Because he was charming, connected, and regulators couldn't imagine that royalty was robbing the kingdom. The watchdogs weren't just asleep, they were starstruck. And every year they looked away, thousands more people handed Madoff their life savings. But every Ponzi scheme has the same fatal weakness built into its DNA. It must grow forever. The moment more money flows out than in, the machine dies. And in 2008, the machine met the financial crisis. Markets crashed. Panicked investors everywhere needed cash. So they asked Madoff for their money back. First millions, then billions. By December 2008, clients had requested $7 billion in withdrawals. Madoff had a few $100 million left. The math that Markopoulos saw in 5 minutes had finally arrived at Madoff's door. Madoff pleaded guilty and was sentenced to 150 years in federal prison. He died there in 2021. Investigators spent the next decade clawing back money and, remarkably, recovered over $14 billion for victims. But the trust he burned, that never came back. So what's the real lesson of Madoff? It's not watch out for criminals. It's this: the biggest lies aren't hidden in the shadows. They're hidden behind reputation. Madoff didn't fool the world with clever accounting. He fooled it with a resume. NASDAQ chairman, country club legend, the guy everyone's smartest friends already trusted. And the one man armed with nothing but math was ignored for 9 years. Because numbers don't have a reputation. So the next time an investment sounds smooth, steady, and too consistent to be true, remember the 17th floor. Real returns are messy. Perfect is the red flag. If this story blew your mind, this channel is going to be your new obsession. Every week on Money Empires, we break down how the world's biggest fortunes are built and destroyed. Subscribe so you don't miss